Thank you so much for everyone joining our second Insight event. It's always so mad, like just thinking, like, when we started 2 years ago, not really having a community, and now, like, we have people signing up for our virtual events and stuff. We really, really appreciate it. And ultimately, we just want to add value to you guys and give you insight into the various different fields in the corporate sector. So again, like if you know any friend or anyone that, would like to understand some of these industries, like be sure to kind of share it with them. But again, we thank you guys for being here. I appreciate that it's after hours. But yeah, with that being said, our guest today, we'll kind of go through like his profile and like what he does in the corporate space kind of thing. But we're going to be delving into the world of asset management. And, I work in asset management and I can hand on heart say I'm coming to this session to learn as well, because this presentation is fairly detailed and, I'll be, taking notes, and I'd advise you guys to take notes as well. I kind of looked at the presentation beforehand and it's like fairly detailed. And yeah, I don't want to steal the thunder from Luke, because he's very much going to go into depth on various different things. So this session will be long to a certain extent, but we'll try to keep it on the hour if so. And yeah, like there'll be an opportunity for questions as well. But you can sort of like drop your questions in the chat as we go along, and I'll position them to Luke throughout the process of the presentation and after as well. And again, you guys like feel free to interact in the chat section, because I know the last event that we had, there were a lot of like I guess like feedback in terms of just interacting with one another, and people wanted a chance to network. So like you can see people are dropping their LinkedIn links as well, so you guys can kind of connect with each other. So yeah, and with that being said, I will hand it over to Luke to talk us through asset management, man.
Hey, all right, thanks, Stephen, and appreciate the introduction. And again, thanks everyone for coming to listen today. I don't want to talk too much about myself because I'm not really that interesting, but on the next slide, I just give you an outline of sort of what I do, which is currently I work as an equity research analyst, and usually analysts will have a specific coverage or area that they look at, and I'm a generalist, so I look at any sectors. So sectors like financials, industrial, consumer discretionary, consumer staples, healthcare, etc. And I look specifically at US mid-cap companies. I've been working in the industry for just over 2 years now, and I started my career at Schroders, which is a large UK asset manager. And I graduated from the University of Bristol 2 years ago, where I studied economics and politics.
Nice. Just quickly to kind of ask you, I'm sort of trying to do a bit of a jargon buster. Quickly, just high level, explain what a mid cap like is.
Yeah, sure. So it's mid cap. So public companies, which is what we learn, or companies in general, have a value, and value that people measure it by is market capitalization. And you have, generally speaking, you can categorize things as large cap, mid cap, small cap, and then micro cap. And mid cap companies, the way my team sort of categorizes them is anything above 500 million market cap to up to 15 billion market cap. And to give you a sense of how that fares against some other companies that you might be familiar with, Apple has a $3 trillion market cap. Tesla has a $1 trillion market cap. So we're quite so mid cap is quite small relative to some of the large players. But actually, in the grand scheme of things, if you think about SMEs and different type of business out there, a 500 million to a $15 billion market cap company is quite large. They'll have anything in the range of, depending on the business, 1,000 employees to up to 10,000 employees. So they are quite big.
Noted, noted. So to just like, sort of summarize, like mid cap is just in terms of like how much the company is worth and relative to like the size of the company as well, basically. Noted.
Cool. Yeah, so let's give you an outline of what we're going to go through here. So I'll give you an overview of how I think about the asset management industry and the ecosystem that it operates in, and we'll look at some of the key stakeholders that sort of exist in the ecosystem, and contextualize what the function of an asset manager or an investment manager is. And we use the word asset manager or investment manager pretty interchangeably in the industry. And then I'll talk about what I do as an investment analyst. What's the key function that I sort of serve within the organization, and then I'll touch on sort of high level, how I think about investment and looking at the sort of science and art, and then we'll kind of go into other things after that. So we'll jump straight into it. I think the next slide is this massive sort of model. So, I'm a student of economics, and what we like to do in economics, and for any of you who are studying or are students of economics, we like to simplify the world and make models. And this is how I would, like to characterize the asset management industry. Effectively, asset managers, similar to any other organization in the financial industry, exists to essentially facilitate the movement of money, right? And it facilitates the movement of money from those who have it, such as asset owners on the right-hand side in this example, to those who need it. And in this example, I've chosen the case of governments and corporations, right? And it's all about moving money from one side to the other. And you might ask, so why do governments and corporations need money? I mean, it's pretty sort of self-explanatory. Governments will need money to fund public service programs such as infrastructure, healthcare, education, defense spending, this sort of thing. And corporations will need money because they'll need to effectively grow their business, and that means investing in new products, investing in their people, in new factories, growing in new markets, or expanding into different geographies. And money is just a way to facilitate a certain objective. Now, how do governments and corporations get this money? They need to incentivize it to come to them by offering some type of return, right? And the return that they offer must be commensurate to the level of risk inherent within the government or corporation. And we'll talk about this concept of risk and return because it's quite fundamental to investment, right? I'm sure a lot of you have heard this risk and return concept. And so the corporation governments need to offer some level of return in order to incentivize the money flows. And so the other question is, why do asset owners need to earn this return? Why do they need their money invested? Simply put, and maybe stating the obvious here, they need it to effectively achieve some kind of financial objective, right? And depending on the type of asset owner, so we have pensions, insurers, sovereign wealth funds, family offices, endowments, foundations, etc. They have a specific financial objective. So let's take a very simple example. A pension fund needs to generate a return to help the pensioners save for their retirement. And they need to earn that money over time, such that when they retire, they'll have a nice pool of money that they can use and they can live off once they stop working. And depending on the asset owner, right, they'll have different, what you can say, risk and return appetites. And that means they'll invest in different types of assets. And so they might go for riskier assets, they might go for less risky assets, they might go for a certain type of corporation, a certain type of government, maybe a developed market government or emerging market government. And depending on their needs, the objective is to basically find a home for the money that is basically well placed. And that's the role of the asset manager. The asset manager is effectively serving this function of capital allocation. It's about getting these various clients and demands in terms of where money would like to be placed and matching it with where money could be placed and figuring out what is the optimal sort of matching in order to effectively achieve, on the one hand, the financial objective of the asset owners, but also the investment needs of the corporations and the governments. So asset managers are effectively capital allocators. And I'll just finish off with this one point before I pause. There are many different types of asset managers. As you can see here in the middle, you've got BlackRock, Blackstone, PIMCO, A16Z, you've got venture funds, you've got fixed income and bond investors, you've got hedge funds, you've got long-only institutions, you've got long-short. There's a lot of different ways you can invest. And that's great for someone who might be interested in working in the industry, because it means you can kind of find the home that suits you. And depending on how you think about investing and what you like to focus on, there are many different ways to basically cut the cake.
Noted. No, thank you for that comprehensive explanation. I think you kind of went through everything clearly, to be honest. And I kind of just mentioned to people, don't be afraid to drop questions in the chat. But I'm conscious of time, so we can kind of move on to the next slide and then talk about questions in the end.
Sure. Cool. So we'll touch on a few of the technical sort of concepts, maybe not technical, but sort of a bit more of the nitty gritty. And I'll take three very sort of basic fundamental ideas that sort of you learn as you work in the industry, or if you take exams like, excuse me, the IMC or the CFA. So we'll start off with time value of money, right? Time value of money is this concept whereby effectively you would prefer a dollar today rather than a dollar tomorrow, right? And why is that important? It's important because different assets or different investments will have a return, right? That is over a period of time. And the time of value of money is useful in effectively helping you assess and making different investments comparable. Let's say you have an investment, let's call it a 10-year bond. It will pay you $10 every year for 10 years, right? You need to basically figure out what is the value of all those cash flows today, all right? Now let's take another asset. Let's say there's something that doesn't pay you for 10 years, but then on year 10, it will pay you $1,000 a year for 10 years. So you've pushed it out a little bit, but you earn higher. How do you compare the two? The time value of money is the sort of tool or the concept that you use in order to assess assets between each other. Okay. Now, what is an asset? So let's look at the idea of an asset class. I've taken some examples here. You've got equities, fixed income, real estate, things you might probably have heard before. An asset class can be understood as a group of investments or a group of assets which effectively behave in a similar way, and basically they have similar characteristics about them in terms of risk and return, which are different to other asset classes. So fixed income will behave differently to equities, and equities will behave differently to real estate, and they will behave differently to commodities. And you will try to group these asset classes together, and basically you build your portfolio. And this is what the asset owners will do. They'll get a portfolio of things that have maybe 30% equities, 20% fixed income, 40% real estate. My maths is probably not adding up to 100%, but you got the idea, and mixing it in different variations depending on, again, your risk and return appetite. So if you want to take more risk, you're going to go in a riskier asset class. Maybe I'll get 80% equities and 20% fixed income. Maybe you want less risk. How about I take 70% fixed income, 20% real estate, and 10% equities? And the sort of art to it, in a sense, and the science is about how do you find that portfolio that suits what you need to meet your financial objectives. That's kind of the exciting or interesting part. At least I find it exciting.
Got you.
Now,
Quickly, just to kind of ask
yeah,
a
go for it.
question, you mentioned about riskier assets, right? So you mentioned equities being a lot more riskier than fixed income, for example. Could you just on a high level kind of explain why like equities would be a riskier asset in comparison to fixed income?
It's a great question. Now, again, this is a great point because effectively you have some kind of crossover. So there are some equities, all right, which are actually less risky than fixed income. So even between asset classes and within asset classes, the risk return might not actually match. But reason fixed income is less risky, broadly speaking, is because what is a fixed income investment? It basically generally, there are a lot of variations, but let's say generally for most of the time, it is a bond. And a bond is basically say, I give you £1,000 or whatever, and then I will get my interest rate, my coupon, that's what you call it, $10, $10, $10, $10, $10, etc. And then I get my principal back, right? So what is the downside of the fixed income? You just don't get your $10 coupon, something like this, right? Now, equities have both upside and downside, but the downside to equities is kind of your investment can generally fall to zero a lot of the time. But for fixed income, it's less likely that it will fall to zero. You might lose out on some coupon payments, but generally speaking, you'll very likely get at least your money back.
Mm-hmm. Noted. And I guess like just to kind of add on to that point, in more simplistic terms, like with equities, you're investing in shares in a company, and a company is more likely to go bust. Whereas with a fixed income product, such as a bond, typically a lot of the issuers of bonds are governments, and typically you wouldn't expect governments to really go bust. Like the government wants to pay back the coupon. Yes, they may default to a certain extent, and obviously, as you've mentioned, there's different variations of fixed income. There's also bonds that can be issued by companies, but for the most part, it's usually an IOU from the government, basically, and they're more likely to pay it. So I hope that that's sort of clear to
Totally.
everyone. But again, just kind of trying to simplify it as much as possible for people to kind of like really understand, because they might actually be interested in this, but
Yeah,
might think, oh, like, it's a bit too complicated. But yeah, sorry.
totally. And we'll finish off with this concept of risk and return. But I think Stephen explained it very, very well. It largely depends on who is it you are giving money to. And a lot of money in finance and financial institutions, etc., are built on trust to a certain extent, and also legal systems, etc. But how is it? The question is, how likely is it for you to at least get your money back, or even make some kind of return? And there are some things that are just more likely, um, that you are less likely to lose your money. For example, governments. Everyone loves lending to the US government. Why? Because it's very unlikely for the US government to default. Why? Because they can basically tax the American taxpayer, and the American taxpayer is kind of one of the best tax bases you can tax from. And the more and more you go up, the riskier things get. Now, one thing I want you to note in this idea of risk and return, and it's quite a misconception, is people will say, in order for you to get a higher return, you need to take more risk. That's true, but not entirely, right? It's not like, in order for me to kind of make $1 million, I need to kind of walk in the road blindly and risk getting hit in the car. And that's not really how it works. It's more that, and this is very key, in order for money to be incentivized to go into riskier investments, they need to be offered the potential of a higher return, right? So that's why emerging markets, governments or corporates, it's very risky investing in zero. Look at what happened to China, look what happened to Sri Lanka, look at what happened to a lot of emerging countries in 1997, the Asian financial crisis. They're risky investments because their political institutions aren't as developed, because their economies aren't as developed, because their demographics aren't as developed. But they still need money, and the way that they can kind of incentivize money in order to grow their economies is by offering a higher return or a higher yield. And I'll stop there.
Noted,
If
noted. Yeah,
there's
there's a couple of questions pouring in, but again, great questions,
questions.
guys. We'll be sure to answer them at the end. But moving on to the next slide.
Yeah. All right. So very quickly about what it is an investment analyst, and maybe a lot of you already know this, but um, in short, in summary, it is these three things. It is about getting information and data, right? Collecting it from whatever sources that you can get, conducting some kind of research, interpretation, or analysis of said data and its slash information, and chugging it through your brain, or even if you're a quant investor, putting it in through your models, your quant models, and have it give you, have it get to a certain investment decision, right? Because that's what it is. Remember, you have to basically figure out what is it that you want to. You got a pool of that. You got a pool of capital. You got some money, and you want to find out where's the best place to put my money, and that meets the requirements of the end investor. And so I'll go into the next slide very quickly to kind of give you a sense of the type of information and data that we might look at, right? And so there's different types of information data you can have. You've got Form 10Ks, which are basically annual reports, and they kind of outline you the business, the risk factors, the financial statements. You can go through Bloomberg, a very common sort of information service provider slash software that is used in the financial industry. You've got Reuters as well. You can look on the news, FT, Bloomberg, Reuters.
Oh, looks like we've lost Luke for a second. Bear with us, guys.
I think I got kicked out there. I'm back in now.
Yeah.
Yeah. So as I say, yeah. So there's a lot of data, and then you've got to do your research analysis.
Oh no.
And the skill of the analyst depends on research and interpretation of the analysis. Because someone can look at the same pieces of information, right, to a different conclusion. I could look at Tesla and be like, yeah, you should buy this company. But I look at Tesla and say, no, this company has valuation poor. We need to short it over the next 2 years. And the guy lost the job. Real industry, hedge fund, but not, yeah. And so, the skill of the analyst is about how they about the skill of an analyst. Do you, when recommending an investment, are you analyzing the information in a different way than everyone else, or are you having some kind of behavioral psychological edge that other people have? Maybe people are all scared about consumer discretionary stocks, you know, um, but I might love them because when in the long term you look at 100-year, 200-year stocks, they all go up basically up to the right. Stuff like this, basically. And then you give your investment decision.
No, thank you for that
Or you
comprehensive.
could be a quant programming, use Python.
Sorry, thank you for the comprehensive overview, Luke. You seem to be lagging a bit, so not.
I was just going to finish off. I'll rejoin the call.
Yeah, no, that's no problem. That's no problem. I'll kind of summarize what you're kind of talking through here. But I guess in essence, what Luke was basically trying to say is that there's a lot of data that investment analysts would have to look through in order to basically recommend a trade, right? And he did kind of like, mention a few technical terms, but ultimately the essence of what he was saying was that, an analyst may look at this data in one way and interpret a different recommendation, whereas another analyst may look at it and have a totally different recommendation. And I think he used the example of Tesla, for example. So one analyst might look at Tesla and look at all the information available on the company and recommend that, yes, Tesla, in fact, is a good investment and we should buy it. Whereas another analyst might look at all the underlying data for Tesla and be like, no, in fact, we have to short it. And what short basically means is that they'll basically bet against the company to say that the company's value is going to go down basically, and that's why we should short the investment. So that's kind of like what he was talking through, but he's back now, so hopefully the connection
Yeah.
should be good.
Yeah. Let me know if it's not.
Yeah, no,
Then I can.
yeah, it sounds good now. Fingers crossed we should be good.
Great. If not, I'll dial in from my mobile.
Yeah, no, that's
Um, but yeah, I think Stephen kind of summed it up. But just to finish, but a quant analyst might, use models, programming data to kind of process the information and come out at some output. So the whole point is like there are many different ways to analyze or recommend an investment. So it's not just one way. And I think that's one of the kind of great things about well, I think the one great thing about investing is just it's about the person, it's about the individual, and how do you approach the problem, right?
got you. Do you want to move on to the next slide?
Yeah, sure, go for it. Yeah. So this is just kind of, for example, I might make financial models. That's my approach. Using Excel, that's kind of the main tool I use, and kind of taking different types of data, market share, that sort of thing. But yeah, let's move on.
Got you. I think we'll kind of come back to that slide because a few people kind of asked, like, the technicalities and what kind of skills
Mhm.
you need to carry out your job. So we can kind of come back to that at the end.
Yeah, definitely. But okay, so this slide, I won't spend too long on it. But again, it kind of just hammers this point about what I believe is the science and art of investing, right? Because it's about questions about the world and how you think about things, and how you assess risk, where there is some kind of methodology or general approach that people take to tackle these problems. Fundamentally, it's about, how much return could I potentially make and how much risk am I taking? But how do you measure that? How much return do you think you're going to make? These companies are going to be around for 10, 20, 30 years. Who would have known in 1997, Amazon was going to be the company that it is today? Could you have known at that period? How would you know about Apple? Apple went up and down for like 20 years before the iPhone came out. And now it's the most valuable company in the world and in history, right? So there's an art to it. It's not just about like the numbers, but the numbers are important because you can't just basically say like, yeah, buy anything and everything. So some of the questions you kind of, have an answer. You can have a view. You can have a view, but it's not necessarily an answer. And the way you basically want to make investments, at least in specific to my role, is having a view that is correct, right? So, questions like, how do you measure risk? What is risk? How long can the US government borrow money for? Is it 20 years, 30 years, 50 years, 100 years? Argentina has a 100-year bond, which is crazy to think about. It's in a lifetime that we won't even exist, probably. How do you diversify a portfolio? Because things change, the world changes. A diverse portfolio, a portfolio might be diverse at one point in time, and then tomorrow it might not be. And how do you compare different investment opportunities? How do you compare between a Microsoft and a Google, or a Spotify and a Car Gurus? So these are the kind of questions where that we basically look at day to day, or at least I look at day to day.
Got you. I think you kind of covered like a question that someone asked as well, but again, we'll kind of like round up at the end.
Sure. So key takeaways, I'm not going to run through these, but, like we've talked about some of them at a high level. We talked about, so this concept of fiduciary duty. Now, what I want to hammer home about what the industry is, the industry exists predominantly. There are some people that kind of, at least for large institutions like Federated Hermes, Schroders, BlackRock, it's a fiduciary duty. It's not our money, so you can't just kind of spend the money or invest the money the way that you think it should be. It's about how you think it acts in the best interest of the clients, because we're in a position of trust in order to help our clients achieve their financial objectives, right? And we talked about capital allocation. So I'm just I'm kind of highlighting some of the keywords here that I use in the industry, so that if you ever come into an interview or someone asks you about why you're interested, you have these keywords in your mind, right? Risk-adjusted return, investment returns. You're having an informational advantage, analytical advantage, and psychological advantage. It's all about, at least in the active management industry, which I won't kind of dwell too long about the difference between active and passive, but in the active management, you need to have some form of advantage in order to generate good investment returns. Investing is a process. Yes, it's about achieving a financial objective, but the best investment teams have a great process that they can continuously find investments for 10, 20, 30 years. Look at what Warren Buffett's done over 40, 50 years of his career. It's about changing his process, always learning. Because someone might be lucky for 10 years, make great returns, but then for the next 20, they make nothing. So it's about having the best process and improving it. And finally, it's an art and a science, and it's about learning about the world and figuring out how you can be a better analyst, or, more knowledgeable about the world and understand it better, basically.
Noted. I just wanted to kind of like touch on the point you mentioned about active and passive. I know you said you weren't going to cover it, but I think
Happy
it's
to.
actually really important, because I think it's important for your job to kind of actually understand that there's a lot more stress to what you do because you're an active investor, right? So maybe kind of touching through like what active and passive investing actually is would be useful as well. So it kind of shows the gravity of why your role is so important and pivotal, and why if you make a mistake, basically, you could kind of get fired. Like, so yeah.
Totally. Great. Yeah. So the way I think I'll try and explain it is by looking at an index, because it's all depends on index. So what is an index? There are many different types of indices or indexes, or it's indices, but there are many different indexes. But a famous one, everyone might know of, is called the S&P 500, and it's a sort of portfolio of 500 companies in the US that include the likes of Johnson and Johnson, Apple, Microsoft, Google, these companies. 500 of the largest companies in the US. And the main reason you want to own an index is because it's diversified. You've got 500 companies, so one company going broke doesn't really affect, because that's 1 over 500, which is about, I don't know, 2%. My math's probably wrong there, 0.2%, right? And you own all of them. You buy every single company, and you basically just track the performance of that index over time. And actually, S&P 500, if you owned it for 20, 30 years, 40 years over the past 30, 40 years, you would have made a fair bit of money, in all honesty. And that's called passive investing. So just owning that bunch of stocks. What active managers try to do is, in essence, pick maybe 50 to 100 stocks, or maybe even less, of the best companies that they think, right, are better than average in the index, and hold those, because it makes sense. You want to earn the best companies. There are definitely going to be some companies in that list of 500 which are below average. So why wouldn't you want to own the above average companies, right? Great. But it's hard. It's hard to do these things, because, and I'll give you a crazy stat. If you get 50% of your calls of your investments correct, that's pretty good in the industry. If you get 55% of them, you're doing really well. And if you can do it consistently, you're off to the races. You can do maybe something like Warren Buffett. So it's hard. And because it's hard, we charge an extra fee to the clients. So long story short, you can own everything passively, or you just select a few that you want to own because you think you can have an edge in terms of picking out the better stocks from the worst stocks. And there will be a difference in terms of the fee that is charged to clients. And I'll finish off on this point. What's been happening in the industry is a big shift towards passive management, right? Because actually, the statistics show a lot of active managers can't even beat the benchmark. Well, no, not really much surprise because it's hard. And I've heard one portfolio manager tell me it's because the industry has grown so rapidly over the last 20, 30 years that there are just basically a lot of bad managers out there. That's his view, not mine, but I can see why that makes sense. You kind of just sit there and say, yeah, I pick 1, 2, 3, here, give me my fee, see you later next year. Market's bad. You know what? It's not my fault. Markets go down. Oh, when it goes well, yeah, hey, I'm a genius. That kind of thing. It happens. I'm not even serious. I'm not even joking. So you've had a big shift to passive, away from active.
Got you. Got you. And yeah, I kind of just wanted to bang home that point of why like your role is so, I guess, like demanding to a certain extent, because investors are coming to you guys and effectively putting the pressure on you guys to make them money by actively finding the best of the best investments, right? And that's why, like, going back to your previous slide where you kind of talk about all the analysis that you're basically undertaking. The reason why you undertake this analysis is because you're effectively an active investor. And as an active investor, you have to carry out all this underlying analysis basically to make sure that you're selecting the best investment. Whereas with a passive investor, if you're just tracking an index, it's kind of like, yeah, we're investing in all the companies anyways. It doesn't really matter. We're just tracking the index. So with that being said, there isn't that much pressure in that respect. But I just wanted people to kind of understand the gravity of why your role is so important, basically. But I think we can kind of open it up for questions before we go into this next part and just cover some of the questions that were in the chat.
Yeah, go for it.
I just
Because I exited the call, I can't see all the questions, but I know there are a few out there. So why
Yeah,
don't
no, that's
you?
no problem. I'll suss them out for you and throw them out to you. So
Yeah.
this one's a bit of a personal one, and if you can just kind of cover it briefly, because of time. Why did you choose asset management instead of investment banking or like traditional finance roles?
Yeah, I mean, to not sound a bit cute or what do you call it? Cliche or something else. I actually didn't choose it. I feel like it chose me. That's probably like the worst answer.
Typical.
Okay, no, this is how it happened basically. I started trading Forex when I was in secondary school. I liked financial markets. And then I read about the economy because I was trying to understand the economy because that's what basically drives foreign exchange currencies, interest rates, etc. And then I started studying economics and politics and realized, damn, this is so interesting. I love it. And then I was looking for internships. Um, and I came across Schroders, investment management, a firm. They came to me. It just popped into my email, and then when I read it, what the industry was, it kind of all clicked. It was basically like this process of trying to figure out what I like. There were certain things about trading forex which I didn't like. Like I didn't like trading 1 day, 3 days, 5 days. I like to do my research about the economy, then maybe take a 1 year, 3 to 3 year view on the euro to the pound or the pound to the USD or the Japanese yen to the USD, etc. So I like taking long-term bets. I like doing research. So when I read this book called In the Intelligent Investor and I understood what investing means and why it's different to speculating, because I mean it's a fine line between speculating and investing. It kind of just clicked. So that's why, so I kind of found the right match, and I haven't looked back. I really enjoy it now. But maybe another way to say this is like it's just kind of trying things out and teasing out what feels good for you. What are the things that you're kind of interest you, and then just pressing on that and keep going until you find the right fit.
Got you. What
Oh,
skills?
right. Wait, sorry. The other part was why I was in investment banking. To be honest, I don't think I was good enough to get into investment banking. To be honest, there were a lot of people who were miles more capable than me. So I didn't put myself sort of in that camp.
I guess that kind of like ties in well to the next question of what skills do you need to be good at your job? Because I would have thought, anyways, and this is just me like down to like my ignorance. I would have thought that the skill set that you're using now in your job as an active investor would kind of translate into the world of investment banking. So maybe you can kind of talk us through what skills are actually needed.
Mm, mm. So you need to be basically good at research. I mean, what does it mean to be good at research? I think what's more important rather than saying you need to be good at research is you need to be curious. You need to have a curious mindset, and you need to want to learn, or at least this is what's worked for me when I applied to places like Schroders, places like Federated Hermes, places like Marshall Wace, which is a hedge fund. Like they want people who are willing, interested to learn, because investing is about learning about the world. It's this constant process of taking information. So if you don't like kind of updating your beliefs and kind of collecting new information and updating, then research might not be for you. Whenever I meet someone that I'm not sort of familiar with, and they tell me about, for example, I spoke to a friend who now started working at IMG, which is like a media type company for sports. I was like, I have no idea how that whole world works. And I just naturally ask him, like, all right, so how does this work? How does that work? How does that work? Because I just want to understand. So
Mm,
research is important. They need to be analytical. All right, this is very important. You need to kind of be able to have logic, rationality, an element of behavioral psychology, understanding how you think, how your brain works, how to assess problems, and how to kind of think through things, in a logical kind of process. And that just comes with time. That comes with just kind of looking at problems, analyzing them, understanding them. And that's kind of definitely the thing you want to build. So research and analysis is definitely important. And I think one thing is, in terms of skill sets, Excel, for example, always useful to have. I mean, it's better if you don't hate Excel. You don't have to love Excel. You don't have to kind of
mm,
know every single function out there, but an understanding of Excel, PowerPoint, general sort of professional services type skills. Communication, this is very important in investment, right? If it's great if you have good ideas and you're bright and you're clever, right? But if you can't tell your portfolio manager, right, for X wide reason, because they have to look at like loads and loads of different companies, and you might look at like 5 or 10, you need to be able to communicate to them what are the key things they need to know and why.
mm.
1, 2, 3 in 2 minutes. You need to be able to do like a 30-second elevator pitch on a stock, or a 2 minute kind of maybe a bit more detailed, or a half-hour pitch. You need to be able to be a good communicator. And I think I'll stop there. But if I find anything else,
So a bit of a controversial one. All of that you've just explained, why wouldn't that skill set naturally translate into something like investment banking?
mm, mm.
Or
In
like
all honesty,
or did you develop this skill set over time? Like, because I'm kind of preempting your answer here, but I feel like what you're gonna say is that at the time when you're doing applications, the skill set that you just explained is not something that you necessarily had like in much depth. No?
yeah, it wasn't really. It was something definitely I developed over time, And in terms of why it doesn't, I mean, maybe it does apply a lot to investment banking, but I think what really differentiates people who do end up going to investment banking, and what differentiates people who kind of go through that training process, is that kind of grit and perseverance, and being able to sort of
Yeah.
do their long hours, and that's something that it's difficult to teach.
Mhm.
That's something that people just have to go through, and sometimes it's not for them. Like for me, I can kind of, the way I approach things is, like, I like to have a diverse set of things I do,
Mm.
right, rather than having this sort of one thing which kind of takes up a lot of my time. And it depends, like, because if you speak to any sell side bank analyst, they super know every single thing about like their sector or their right? But that's kind of what the function that they serve within the sell side ecosystem. But me, I like to kind of do loads of different things because I like to learn from loads of different areas. So I
Got
don't
you.
know if that answered the question, but
Yeah,
kind
no,
of that's
that makes sense to me. I think to a certain extent, like just touching up on the point of grit, I'd kind of describe it as like a lot of investment bankers are like heavily operational, just like executing because you're banging out long amounts of hours, kind of doing the same thing over and over again. Whereas like your role is a bit more broad in terms of it kind of takes you across like different like landscapes, right? You're a generalist person,
yeah.
like in your role kind of thing. So you're researching various different things, right? So yeah, very much like a different skill set then. And I guess like, yeah, that grit is something you can't really teach, especially when you've kind of been cooped up in uni for 3 years and then it's kind of like a cool, now you have to work long hours and try to like do these technical jobs as well at the same time. So
And I
definitely.
might, I'll have to caveat that because don't get me wrong, there are hedge funds out there. The hedge fund is probably the closest you'll get to an investment banking environment in the investment management industry. So hedge funds are very like, depending on which one you work at, it does have that high level of intensity. But generally speaking, at least in like a company like Federated Hermes or Schroders or maybe even BlackRock, I don't know, maybe not BlackRock, it's just a different sort of pace, to put it that way.
Got you. Um, I before I ask this question, because I feel like it's a bit of a technical one that you might like have a lot to say on, but again, want to keep it brief because we might be running out of time. Someone just asked, is infrastructure slash construction regarded as an asset class? I'll just quickly answer this one. Infrastructure, yes, can be regarded as an asset class. Sometimes some people, for argument's sake, might classify infrastructure within like the real estate asset class as well. But I don't know, like, what do you have to say on that, Luke?
Yeah. I mean, yeah, you can kind of describe it as a specific asset class. It's quite unique. It's not like a bond. I mean, it kind of has, it's like a bond. So it has fixed income properties, but it's real,
Yeah,
it's an actual
yeah, it's
physical thing.
real,
So it's a bit
real
like real
assets.
estate.
Yeah,
Right, exactly.
yeah.
It's tied to a specific geography. It has different types of taxes. Maybe if it's a water tax or a road tax or a bridge tax. I don't know.
Yeah.
Yeah. So
And
it is.
and people usually describe infrastructure as like, essential services that keeps the economy running. So that's why a lot of like investors tend to love to invest in infrastructure because you actually need it in the economy. Now, obviously, with that being said, the returns are not as great because it's very much like a less riskier investment than like, investing in a company, i.e. equities, but it's still like, delivers good returns, resilient cash flows because infrastructure is like, you have like these big like infrastructure projects that the governments are running. So, like the contracts are locked in for a long period of time. And you just know that if you invest your money in an infrastructure project, it's kind of like, safe, nice, like good returns kind of thing. But yeah, that's kind of covers that. Yeah, so this technical one was just, do you see any shift in portfolio allocations overall due to the current developments such as inflation, like political risk, like the whole Russia thing, that's kind of happened. Like, what's your view on that? Like at the moment, does that influence the way you kind of look for different companies and opportunities to invest in?
Yes, yes. There is an ongoing shift and a huge shift in portfolio allocation. Like the COVID period was crazy. Now inflation's kind of going crazy, and our interest rates are sort of moving a lot. Fed was behind the curve, so people are rethinking about what they want in their portfolios, and uh, basically the set of scenarios that could play out is very wide. And it's difficult to basically figure out what is the appropriate portfolio allocation when the scenarios are too wide. Like if things aren't as bad as they're going to be, you don't want to be in like defense. You don't want to kind of take risk off. You want to take risk on. But if you think, things are going to get much, much worse, then, things could go down a lot more. And I don't want to kind of get because you can have a 1 hour discussion about portfolio allocation.
Yeah, I was gonna say that.
Like yeah, there's just so many ways to kind of again cut the pie, but they are shifting, they are moving.
Yeah, and I'll definitely say like it kind of like goes on to your point of saying that analysts would approach things in a different way given like
Exactly.
the current market conditions, right? So, a portfolio manager may see like the market's going significantly down and be like, you know what, this is when I want to allocate as much money as possible to a lot of risky assets. Whereas another portfolio manager that's like probably a lot more conservative might be like, you know what, like we're not buying at the moment kind of thing. Let's focus on more research kind of thing and try and like, take less risk, right? And then also like you factor in like the client's profile as well, i.e. the investor's money that you're investing in as well, right? In terms of like their risk
Yeah.
profile. So many different moving factors. But I think long story short of that question is that yes, portfolio allocation is affected due to any like, developments in the market basically. Another question, which was one that I actually wanted to ask you as well, but I didn't ask it. What are the KPIs on a day to day that are measured in your role kind of thing in terms of like, how are you like measured on performance basically
Mm, mm.
as an analyst?
Yeah, yeah, yeah. Um, the ultimate KPI, yeah, is returns that beat the benchmark.
Mm,
So you might, recommend, depending on the fund, you might recommend, a handful of stocks every month, right? And some of them will no doubt do poorly, but some of them will do badly. But when you net them off, you know, which ones, hopefully you'll make more right calls than not, and that's it. Like that's the entire metric. With what an analyst does, it's about how good are your ideas. That's literally it. But it's simple but difficult.
yeah, yeah,
Because
yeah.
also like I was sort of having a discussion with a friend about this, like, or just in a group chat. I was saying like investment is, on the one hand, it's about picking the right thing, but it's also about knowing what to avoid. You can make a lot of money by just avoiding all the crap as
Mhm.
well. And so, you might go through like loads and loads of companies, having a filter and going like, nope, not this one, no, not this one is also important. But yeah, it's basically the ideas that you generate, and it's not necessarily the number of ideas, because you don't want to have 100 ideas and all of them being crap. Maybe you might rather have 10 ideas and six of them are good.
Mhm.
So
Mhm.
it's just about like the quality. That's how I think about it. It's the quality of the ideas. But again, different funds and different investors might have different metrics.
Got you, got you. It's very much like a subjective thing, right?
It is,
Um,
yeah.
Someone asked, like, what is the best things to get experience in if you want to get into this, but you didn't study like a finance-based degree? Like,
Easy. And this is a question that has that come up quite often in interviews I've had. Do you invest your own money in the stock market?
mm,
Yeah. So even if it's a little, even you don't have to have like 10, 20, you don't have to have a lot of money. Even if it's like 100 quid, 50 quid, £10, it's just getting in that mindset of having a process, understanding it, and reading. There's so much information now, relative to 10, 20 years ago, about how to do stock research. It's just there's a plethora of books, podcasts, videos, um, online resources like Financial Legend, these sort of things. Like the first thing I did when I was learning, I went to Corporate Finance Institute and
mm,
just kind of went through all the free Excel courses. It was great, it just gave me a good foundation. But there's a lot of resources, and just start investing your own money. And I remember someone told me like it takes you 10 years to know if you're a good investor. 10 years,
mm,
because it's like you have to go through market cycles, because you might have just been lucky. For
mm,
10 years, you could have just been lucky, and there was no skill involved. But over a long period of time, in theory, the skills should kind of play out. So invest your own money. I think that would be the number one best way. Because if you can go to an interview and say, yeah, I invest in stock market, my own money. I like this company for X, Y, and Z reason. I don't like this company for this is my view on interest rates. This is what I think about the macro economy. This is how I think about portfolio diversification and risk management, etc. Like they'll be looking like, goodness me, like this is
yeah,
amazing,
yeah,
and
yeah.
it's open to anyone. You've got like Robinhood, Trading 212. It's easy accessible to everyone.
Yeah, got you. I'm gonna just move on to the section you were gonna cover just in terms of how you can help. I do appreciate that there are many more questions in the chat, but I just want Luke to cover
Yeah,
this
sure.
section and then we can come back to the questions in the end
Yeah,
as
exactly. I'll whiz through this section because I quite like the questions. They're really good questions. So basically, what me and a friend of mine started was Finmod, right? And what do? We offer basically, in short, what I'm trying to channel through this Finmod initiative is these project-based workshops. So we ran like a whole year one at Bristol between 2019 and 2020, right? And it was great. We basically kind of give everyone the fundamentals, how to use Bloomberg, because luckily Bristol had Bloomberg terminals at the time. And then I basically tried to teach them what I learned from my internship at Schroders about valuation. And I was kind of doing things on the go. I was reading stuff. I was taking stuff from Corporate Finance Institute and just putting it together and offering it. So now I'm kind of rebuffed it after working in the industry for 2 years. And I basically want to kind of just give you 2 years worth, and it will always update because I'm always learning about these things. And I'm taking the CFA, and I'm always learning about the industry and how to invest. So I'm basically trying to take 2 years worth of knowledge and basically give it to you in like, I don't know, 5 sessions or something like this, or a workshop. And it kind of gives you both the technical skills, so Excel, research, communication, PowerPoint maybe, and also the sort of theory about how to think about investing. And what we'll do is basically we'll go through a stock pitch or a stock investment, and kind of let you kind of get on with it. And it's as much a learning experience for me as you. So it's essentially just a course. So if we maybe go through the next slide, this is our mission, a vision, and mission, etc. So there's a website basically. I think there's a link on it, Stephen.
Yeah, we'll drop that in
and
the
and yeah, so what are some of the key principles? It's about this having this T-shaped individual, and there's this concept of having depth in a certain field, but also being able to kind of think about different things. Because I think in my mind, great investors are people who not only understand investing, but understand marketing, business models, strategy, financial accounts, behavioral psychology. Just understand as much as you can about the world. And I'll go to the next slide very quickly, if you please. I think the next slide is the last one as well. Yeah, so this is kind of what we're trying to build. We're kind of build you a professional toolkit, build your network, and just have a bit of enjoyment whilst learning. Because I think I really enjoy investing, and I hope you do too. So, if you're interested, pop me an email or send me a message on LinkedIn, and we can kind of have a conversation to see what we can do. Because I'm quite excited to kind of see kind of do some more workshops basically, because I really enjoyed them when I did it in Bristol, and I've got a lot of sort of knowledge I'd like to kind of share.
Okay, I just dropped the link to
Great.
that as well, so people can kind of like sign up to that as well. And I guess like what I would say to you guys is that I appreciate that this presentation is like very detailed with a lot of like technical terms being thrown about, but you need to understand that it's so hard to try and cover all these technicalities in a 1 hour presentation, right? Like there's going to be so much over explaining to do. Just one concept we could spend like 3 hours talking about it. And what Luke has really got here would really kind of delve into a lot more detail, right? So I'd really advocate for you guys to sign up to the
Totally.
platform. But just going
Thanks,
back
Theo.
to some of the other questions that we had, with sustainability, I like this question because I can actually answer it as well. With sustainability slash ESG becoming more important, how do you incorporate this into your analysis? So you can take this one, and then I'll kind of like cover in with my thoughts.
Yeah, yeah. How do you incorporate it in your analysis? It's a great question. The space is moving so fast, but what I'll give you is two things. I think one way you can think about it is things that can have, it's depending on the level of materiality, right? There are certain sort of areas that you might look at in sustainability. And one way we've categorized it in the industry for right or wrong reasons is ESG, environmental, social, and governance. Depending on the business model, sustainability criteria might impact let's say a company, because that's what I look at, in different ways. So like if you're a tobacco company, great, you've got a good brand, if you like Philip Morris or sort of British American tobacco, maybe great brand. You've got customers who will most of the time come back to you again and again. And you're probably very profitable as well. But at the same time, you're creating some cost because of smoking in the general population, and people's sort of preferences are actually shifting, right? And actually, if you look at the data, a lot of people who used to smoke actually now vape. And if you're not aware of these kind of shifts in society because of certain health benefits, because of this perceived perception, so this perception, maybe it's true or not, that vaping is better than smoking, then you're going to sort of miss the opportunity or risks with the company, right? And so if you're not aware, so Philip Morris have spent a lot of money buying like I think Juul or ICOS or something like this to shift the business model. So it presents opportunities when business model shifts. there's an opportunity. If you look at the sort of oil companies, they have to shift their business models away from oil and gas towards energy transition. Look at what's happening in the automotive sector. Tesla's just wiping all of these, VW and BMW and Mercedes, etc., and all these American like GM and Ford and whatnot. Long story short, it depends on the company, right? But if there was one takeaway, if you look at sustainability, just look at some environmental factors. So that's emissions, biodiversity, water usage, and then some social factors that you might look at is like diversity and inclusion, talent retention, safety, and governance issues such as over like the board and the management, the quality of them. Are you overpaying them? Are you underpaying them? So these are the kind of broad categories you look at.
Got you. And I think that covers it at a more granular level in terms of like your role as an investor and when you're looking at specific companies. But broadly speaking, like I would kind of like use these asset owners as the reason for why like there's a shift towards like, making ESG investments. And the reason being because these asset owners, they only want to invest their money with asset managers that are predominantly investing heavily in ESG, basically, right? So with that being said, what that means is that as an asset manager, you're only going to attract more money if you say, oh yeah, by the way, like, we're incorporating ESG into like a lot of our investments, basically. And as an asset manager, what that looks like basically is just, looking across like all your funds and making sure that, they kind of qualify as funds to basically like invest in ESG oriented stuff, because ultimately once the investors see this, then they're going to be like, oh, like great, like your fund is ESG orientated, here, take our money because like we like this ESG stuff, basically. And that means asset manager gets a lot more money to invest. So that's kind of like the whole idea from like a broad level speaking, basically. Like ultimately the asset owners kind of control everything because they're the ones that effectively have the money, right? So if these asset managers want their money, they basically have to do like, what the market is doing, basically. And at the moment, ESG is kind of like the hot topic. So I hope that kind of covers it. What would you look for in a grad scheme to try and see if they give you good leverage in such industry? It's a bit of an interesting one. I don't know how you want to answer that.
Good leverage. Is that how am I
Yeah, so I
interpreting?
don't know. The way I would kind of interpret that question would more so be like, what firm should you join to like, secure like a good like career progression or something like that, basically. So like, being in Federated Hermes, does it improve your
Nice.
prospects of just like having a good career in the industry? That's the way.
Yeah, yeah, yeah. I mean, I think you got to just go for the big guys. The big guys are a well known firm. Like a Schroders, a BlackRock. Just yeah, especially at the start of your career. Why? Because they're going to be more well resourced to an extent. They're more likely, although not always, going to have probably a better early careers program. I know Stephen might have probably different views on this. Um, but yeah, so they're more likely to have a better early careers program. There's a larger network there that you can interact with and learn from, and they're more established. And so I think it's definitely it's never it's never probably a wrong choice at the early stage of your career to go for a big name. And I think me having Schroders on my CV actually does go quite a long way, but for the right reasons or not. But I think it just does because I've always sort of at least gotten some initial responses if I'm applying for like a role.
Mm.
So
So
it does
yeah,
go.
I think what I would kind of say to that, not hardcore disagreeing, but I would just say that it kind of depends on like the role and the industry that you want to go into, right? So like typically if you want to work in asset management, like every asset manager is pretty much big. So nine times out of ten, like you're pretty much gonna work in like a predominantly big asset management firm if that's where you want to go into. Whereas, like, if you're thinking of going into something like consulting, for example, I would argue that it's good to kind of go into a smaller firm because, first of all, it's super competitive trying to get into the bigger firms. And then, secondly, if you go into a smaller firm, you're exposed to a lot more, you can make a lot more impact, and you can get a lot more like hands-on experience. So I think it ultimately just kind of depends on the industry and the role that you actually want to go into. But yeah, I would definitely say, like, for something like asset management, 9 times out of 10 you're gonna end up at a big asset manager anyways. And if you can kind of target the big names so that it can kind of like propel you in terms of like, career prospects down the line, then yes, like that's very much the case.
Totally. Yeah, the small firms don't really hire, although I think they're slowly changing.
Yeah,
Yeah.
I think the small and the small firms in asset management don't hire because they're still trying to get off the ground. So they
Uh,
haven't got time to like take on junior talent to be training them to be great investors. Whereas like a bigger firm, like they have a lot more capital, they can invest in a proper early careers program, and they can quite frankly take the risk on hiring juniors that don't really know what they're doing at the start. Do you know what I mean? And train them up, right? So that kind of makes sense.
I will also add one last caveat here. Like big or small, wherever you end up, I think just like focus on finding the right team or right company that fits you. Actually, this is something that probably like people don't really talk about, but like it makes a big difference on your sort of well-being and your mental health and your general sort of satisfaction with your job. If you work for a company that you think sort of is a great place to work, and there are great small places to work, great media places to work, and bad big places to work as well. So it's just sort of like be aware of that. Like when people are interviewing you, you got to be interviewing them as well, etc., etc., and seeing if it's the right fit.
Got you, got you. No, thank you for that. So another question as well, guys. I do appreciate that we're kind of like, over as well, but I just want to cover all these questions for everyone that asks. What advice would you give to someone working on improving their commercial awareness and prepping for technical interviews? Quick one. For technical interviews, make sure you follow Finmod, um, so you can be clued up. And then yeah, you can cover the commercial awareness bit, Luke.
Yeah, commercial awareness. I think the best way, or at least what's worked for me, I don't want to say best way, what's worked for me is have like making it a habit of, firstly, every morning I walk to the train station, FT news briefing on Spotify, on podcast, right? 8 minutes download of the top news stories as you're walking. Just make it a habit. Because commercial awareness is not about like necessarily being able to kind of, I think commercial awareness is partly about like your ability to kind of give a certain, showcase your knowledge about something, but it's also about following what happens in the world and understanding the stories that play out. So just making a habit of reading the news, and if you have someone interested, that someone that might be interested in discussing it with you, that's even better, because then when you have discussions, you can have different viewpoints and stuff like this, and your brain just kind of it cements more in your brain. So just read, discuss. It would probably be my best, and make a habit of it. You don't want to sort of like all of a sudden read about everything like 1 week before an interview or something like this.
Mm.
Like the longer amount of period. When I first started reading about the economy, I had no clue what an economy was, what interest rates were, or how they work. But after like 6 months of reading it, quite consistently, you pick up on things.
Yeah, got you. A few plugs as well, I would say. If you want to really enjoy like commercial awareness news relating to finance, I would say sign up to this page called ExecSum. I don't know if you know about ExecSum, Luke, but it's basically like just this page that distills like investment news in like memes and stuff, and it's the most funniest thing ever. And that's really what got me into like commercial awareness and kind of like what motivated me to start like a weekly newsletter for Beyond Education where we distill all the like commercial awareness news in the week into like like one like 2 minute read basically. And then I always plug ExecSum as well, but ExecSum, they send like daily newsletters, so I definitely say you guys check it out. I don't have the actual link, but I'll just type ExecSum, so you can kind of like go and Google it. You be sure to find it there.
Yeah, newsletters are great. Newsletters are
Yeah.
really good.
Yeah, but yeah, just I think yeah, capitalizing on Luke's point, just make a habit of actually like trying to be aware of like what's going on in the economy and just like reading up on it every day kind of thing. So it's just like second nature. Um, Another question: how useful is coding for your role? How did you learn to code? I didn't even know you knew how to code, to be honest. But yeah.
Yeah, I mean, so the it depends on the role. For my role specifically, there's no coding. But for a quant team, there will probably likely be a quant, so some kind of modeling or programming. And my knowledge of coding only goes up to the extent that I know how it generally works, but I wouldn't know how to. I'm not really that good at executing. I kind of know what it's capable of. And actually, in Finmod, we did do sort of one video on using Python and quant tools, etc., to do research. investment research analysis. But yeah, so I don't code, but for teams that do, and if you are interested in coding, there are quite a few places you can find a fit. It could be on an investment desk, it could be on a data insights unit, or using data to support investment decisions or investment research and analysis. So yes, there's opportunities there for anyone who's interested in coding.
Noted. There was someone within the audience that actually put their hand up, and I'm not sure if they actually wanted to come on, turn on, turn on their camera, turn on their speaker.
Yeah,
The
I think it
question.
was Pratip.
Pretip.
Oh, hi. Yeah, I did have a question earlier about like in terms. It was similar to like the coding one as well, and how like I understand like generally, unless you wanted to be in a role somewhere like quant or something, coding is not really necessary. But I guess my question is like if you had those extra capabilities, would that kind of help you in like getting your foot through the door? If that makes sense. I'm not
Yeah,
really. Yeah.
yeah, it's a good question. I know what you mean. I think what would I say about this? I wouldn't say it kind of gets you more in the door. It it depends on the role you apply for, right? And so, like, if I look at example of Schroders, right, there were some investment graduates, such as myself, who had coding capabilities, and they were then slotted into the teams that had some more sort of coding work, right? So what I would say is like, figure out what you want, you know, and it's never a bad thing to have some coding knowledge, right? Because I have some, because it might just give me an edge, but I haven't found it. I haven't found it come into my interview conversations. They might, because what you don't want to do is like build coding knowledge, right, to get into a role and do the role that requires a lot of coding knowledge, but you don't like coding. And that happens sometimes. But maybe that's a process you need to take in order to find out, yeah, I effing hate coding, so yes, it's never a bad thing to have some knowledge, and that's what I do. I have some knowledge of coding, but it's not like in my primary repertoire of my skill set that I would say, yeah, I would kind of identify as a coder. Yeah, exactly. So like, if you go back to that slide, Stephen, it's just having this sort of T-shaped individual. It's about having some depth that you are passionate about, but also having some general understanding of different areas.
Noted. And I would also kind of say, like, you don't really want to shoot yourself in your foot leading with a skill that you're not necessarily like adept in. So, for example, if you've just been dibbling and dabbling in a bit of coding, I wouldn't go to an interview and then be like, yeah, like, I'm a massive coder kind of thing, because then you'd get put into a role that, number one, you probably can't do, and then number two, you just end up hating. But what I would say is that, I think what I kind of understand from your question, Pratip, is that maybe just like having like a basic understanding and skill set of coding would probably allow you to like keep up with like financial analysis or something, because it's purely like analytical at the end of the day. So I kind of understand it from that perspective. But I would kind of say you don't need to go out of your way to learn coding to be in Luke's role. Correct me if I'm wrong, Luke, but
Yeah, this is right.
yeah.
Not in my role specifically, no.
Yeah. Eliakim, you had a question. I saw you put your hand up.
Yeah, hello.
Yeah,
Yeah.
go through, bro.
Yeah, so there's a question for both of you, since you guys are, in the same field. I just want to know if there's a lot of people who did different courses. For example, I'm currently doing engineering, who have transferred into doing asset management, and whether do you feel like I have the right skills to to transfer into the positions that are in asset management.
Do you want to cover? You want to go first, Luke?
Sorry, so you went into it's from engineering and now you study asset management?
No.
No. I'm currently doing engineering,
Uh-huh.
electromechanical to be specific, and I would like to, use my skills, and then obviously through transferable skills, try
Go
to
into
get
asset
a
management.
position.
Yeah.
Got it.
And I think the question he was asking is that do we see a lot of people within our industry basically have like
Yeah.
not necessarily like finance based degrees go into asset management, and if so, like is it possible basically?
Yeah,
Yeah, go
sorry.
on.
Yeah,
Go on.
long story short, yes. Long story
Mm,
short, yes. Because you got quant funds, you got asset managers who want to become more tech oriented,
Mhm.
but even if you don't want to be working on a quant fund or on a tech role, right? just the mental models, for example, as I'm sure you know, that you acquire in engineering, right? Whether it's about being precise and taking all the variables and building a model and understanding how something works. These are all useful. These all can be useful to investors, right? And just coming back to the T-shaped individual and the skill of an analyst is, how do you look at the world? How do you assess the world? How do you understand it? And the stuff that you learn in engineering will probably be useful in the way that you want to look at it.
Yeah.
So yeah.
Yeah, I would also say, I don't know if you noticed this, Luke, but a lot of the old heads in asset management, they did like classics or something. Like
Yeah.
a lot of these people actually never studied finance degrees. Like
Yeah.
or like
Definitely.
history in Cambridge or like politics or something, right? So I would definitely say you can definitely get in. And then more time, like you don't really get the transferable skills from your degree for the most part. You kind of like learn the relevant stuff outside of your degree, as Luke was saying, like doing all these like ad hoc courses and stuff, and that's where you learn the skills needed to kind of understand the lingo. And then when you get into the job, again, I'm pretty sure like to a certain extent your degree doesn't even come into it because you're learning on the job kind of thing. So that's what I would say. And then also going back to Luke's point that he kind of touched on as well, if you did want to use your degree, there are a lot of asset managers that would want to like, leverage like your expertise of understanding like, like industrials, for example, would be a great place for you to leverage like your engineering skills, right? Because a lot of asset management firms that are investing in the industrials industries, they want to go and see the plants, they want to go see how manufacturing is working. So you can kind of pop up as a subject matter expert in that respect to kind of be like, I understand this stuff because I did engineering. So then you're kind of like, you have an edge in that respect. So long story short, there's many different ways you can really play it, to be honest. So I would say it's pretty much an advantage, to be quite honest. That's what I'd say. But yeah.
But is there like much more specific roles which are skewed to engineering, like infrastructure?
Yeah, exactly. So that's the thing, and it's kind of like, I guess like beyond education, we need to do a better job of finding like, people that have done stuff like this and made moves like this, and taking unconventional routes into the field, right? And rest assured we'll try and find content and stuff like that. But I think like honestly, your degree doesn't matter to a certain extent, and your degree is most definitely like transferable, like, right? So you can go into infrastructure, you could work in the industrials team, like there's so many ways you can look at it. But long story short, you can get into the industry regardless.
I mean, imagine if you actually have a huge passion for electrical engineering, right? Go and look at the semiconductor industry, like that would be probably the perfect fit for you because you'll understand it to a technical level that a lot of other analysts will probably not. Right?
Exactly.
So you have the knowledge set that might be useful, may or may not, depending on what your passions or interests are. And then you have the technical stuff, which can be placed in a lot of places.
No, agreed. Someone here was like, I studied computer science for 3 years and found out I didn't enjoy it. Still got a first class, but now I'm in a predicament where I've studied something which I'm not passionate about. I would say like it doesn't really matter, to be fair, because honestly, like you don't even use your like whatever industry you're gonna go into, like you rarely use your degree, and it's kind of like as much as you think that you might be in a predicament or it's waste of time, it's really not. Like at the end of the day, you got a degree, you got a first class degree as well, so that's really good, right? So I don't think it's time wasted, to be honest. I don't know, what's your views on that, Luke?
Yeah, no, I mean it's like, look, I studied chemical physics in my first year, right? It was interesting. I had no passion for it. But it's all a learning process. Like, figuring out what you're passionate about is as much about, looking for the right thing. Sorry, it's just as important to go through the things to figure out you don't like it. How would you know? It's hard to know before the fact, right? But now you do. So now you press in other places, you take what you've learned and you kind of go forward from there. It's a long career,
Exactly.
like it's a long career.
Yeah, no, most definitely. And I think that kind of wraps us up, guys. Oh, I just saw one more question. Do forgive me if this has already been answered, but what would be your views on biggest challenges and opportunities in asset management? Are you coming at that from like a technical standpoint, or are you coming at it from a just working in asset management? Practically, you can actually just kind of pop up and ask that actually if you want, but yeah.
Oh yeah, forgive me, my bad. I would say like I would say like more from a technical standpoint, not just like working in asset management.
Yeah.
So like, what would you say? What would you say like like the question is generally aimed at like asset management firms and like the challenges
As an
and
industry, yeah, that
etc.
makes sense.
Yes, of course.
Got
Yeah, I
you.
mean, some of the stuff that we talked about already, like sustainability, this is a huge challenge, a huge opportunity. You got greenwashing, but you also have like a climate disaster, health problems, water scarcity, biodiversity issues, food shortages, energy crises. These are all about the sustainability of the economy and how do asset managers play a role in that, and how do you basically channel the investments that you need in order to solve some of the UN Sustainability Development Goals, for example. So that's
Yeah.
a huge problem. And the other thing is the shift to passive from passive to asset from active to passive. That's one thing. And I think the final thing I'll say is it's not a growth industry. And I've kind of felt the brunt of this when I was at Schroders, and I got to the end of my 2 years, and basically there wasn't a role for me that they could offer, which I would have taken. So it's not growing, right? So that kind of you kind of want to go for the growth. So that might mean going into private assets. That's a growth industry. That might be going into asset management technology, something like this. It's just something to be aware of, right? The growth has kind of already come. It's a mature industry, but the financial industry, generally speaking, has huge staying power. Like look at Nokia. It was once a great phone company. Now it's not really that great, still around. But institutions like J.P. Morgan, Schroders, they've existed for like 100 years or so. So they kind of just keep chugging away and stuff like this. So even if it doesn't grow, there's still an opportunity there.
Yeah, I think like that challenge point as well, like, sustainability is a really big thing now. And I think I even heard one portfolio manager kind of mention to me, they want to kind of like move towards like, more ESG investing, but that kind of like capsizes their returns, right? So like a lot of people don't know this, but investing in like, the actual like tobacco, alcohol, and all the unsustainable assets actually like, has a lot more returns, right? Because like, alcohol and like the drugs industry, for example, these are like industries that are going to be here forever, and a lot of people are like like they use that stuff on a daily basis. So a lot of portfolio managers are kind of mentioning that trying to go into this ESG like tilt at the moment is like fairly difficult, even though there's a lot of opportunities there as well. And I think like as far as opportunities go, I definitely agree with that sentiment of the fact that there's a lot of asset managers, so like growth is very, very, very limited in that respect, basically. But yeah, Ollie, you had a question.
Yeah, I did, which you ignored.
God, Ollie, I missed it. I missed it. What is it?
Nah, it was just a quick one. When you were talking earlier about tracking the numbers and going off numbers and whatever the system says, I just wanted to ask him, like, how far can you be led by the numbers? Because at the end of the day, you're still gonna have to make that ultimate choice as to whether you invest in that fund or not. So how much should we read into numbers, or is it still a case at the end of the day it's still about human error?
It's a great question. It's a very, very good question. And so, I mean, I'm going to assume when you say the numbers, you're referring to like
The
quantitative
data,
models.
yeah.
The data, yes. So, like, I mean, so let's focus on quantitative models because I think there might be another way you're thinking about this. But effectively, the people who create quantitative models need to kind of have a bottom-up philosophy about how they want to arrange the processing of the inputs. That the model is built for themselves, and some funds will have like a final layer where, as you said, there's still a human there, and they will make the final decision based on what the model says. But there are other funds out there that literally just kind of let the model do what it does, right? Again, it depends on sort of the approach you take. But the metric that you want to measure the quality of the process on, whether it's like there's a human intervention or it's just all computer led, look at the returns. A great case study if you guys want to look at it. Look at Renaissance Technologies, and James Simmons. They call him the man who solved the market because he was basically able to create this mathematical model that just got it right. Sometimes it just gets it right. But at the end of the day, you kind of need to have a feel for the markets, and sometimes the models get it wrong. So, for example, in COVID, I think a lot of quant funds lost a lot of money because their models weren't kind of parameterized or optimized for something like COVID to happen, which is like a 1 in 150 year kind of event. So yeah, it depends, but yeah, there is some element of human input. It's not just like a computer. Well, not yet, maybe maybe it will be done by computers. Who knows?
Well, to be fair, that's going to be my next question, because you mentioned something about like the industry is not growing. Like there's not that much opportunity for growth. So that's what I was going to ask you. Do you think like the computers are going to take over and just be them investing, and you're just sort of watching them?
Yeah, and I think again, you like the way that's a great question as well. And like, one way you can maybe think about it is like, what do you think the asset owners might want? Do you think asset owners or the clients will be happy with just a machine doing everything for them? I don't know. Maybe some clients are happy to do so. Others might be like, no, that's just weird, man. Like it depends. So it's an unanswered question, but we'll see what happens. But the way I think, one way you can think about it is man versus machine, or human versus machine, right? But what about human and machine? How can machines be used to facilitate what the humans do, and maybe fix some of the behavioral disadvantages and improve the kind of investment decision making process. So I don't think it's kind of like one taking over the other, although there is a shift to quant funds. But there's this whole new kind of concept called quantamental, which is fundamental investing, and quantitative investing put together. So it's great, yeah. So like that's an area where there's like a pocket of growth there, definitely, I would say.
That's good. Wait, last question, if that's okay.
Yeah, go for it.
So do you remember you said something earlier about a manager said that the markets have changed over the last 20, 30 years, that it's becoming more and more harder to predict. Do you think that's because more and more people are, your average users are now, starting to take an interest in the stock market, in the markets? Like, as you said, trading 212, someone can literally just go open up an account now and get involved. Do you think that's because more and more people are becoming more aware,
involved in stuff like this? Yeah.
It's getting harder.
It's a great question, and there's a few points here that we can touch on, right? And I'll try to kind of say them succinctly, but you have kind of sorry, someone's calling me. So yes, so the point that the fund manager was making wasn't that it's harder to predict. He was saying that there's just been like loads of big fund managers coming to the market, and that maybe like back in the day, 70% of all managers were great, but now you've got like all these new managers coming, they're all actually pretty crap, and now maybe only 30% of managers are good. And it's just a function of like the numbers. It's not like you can have like a million Cristiano Ronaldos. You can probably have like a handful. And so that was his point. But touching on your idea of like retail investors and this sort of thing, right? Look at what happened to AMC. Look at what happened to these meme stocks. They are literally moving the market. Like they're able to do it, but it's like in isolated scenarios. It's not kind of generally a broad market thing. But also, these companies like Trading 212, Robinhood, etc., they actually sell this data. So even if like all this money and retail money comes in, the market knows this because the data is available to be sold by the likes of Robinhood, etc. That's actually how their business model works. And finally, you have to remember, in the grand scheme of things, the retail investor is small, right? The retail money is tiny. These institutions are massive, right? So like in certain specific events, yes, they can move a market, but broadly speaking, they don't really sort of move the needle that much.
Thank you for that, Luke, man, and thank you for the additional set of questions at the end, Ollie. But with that being said, I think we'll wrap up. Like we're basically on the hour, to be honest. But thank you so much for this session, Luke. I definitely took a lot of value from it, to be honest. And I hope you guys like took some value from it as well. And just kind reminders to be sure to sign up to Finmod. Again, I'm actually looking forward to seeing these project-based courses, and Beyond Education are very much going to be an advocate of this, because it's essentially just giving you an edge in being able to navigate these interviews with the best advantage, basically, you know, kind of like learning the insights of like what it's actually like to work in these companies and some of these roles, so that you can put your best foot forward in the interview. So I'd very much say, like, you know, you guys be sure to basically sign up to that. And then, yeah, just, you know, with that being said, just a quick pluggy of Beyond Education. As you guys know, we are a platform dedicated to helping students, predominantly from non-target universities, access early career opportunities. We do this by providing free career resources, insights from like our professional network, and also ad hoc one-to-one support as well. So be sure to check out our website for that. I know it's also application season at the moment, so you guys can actually sign up to the website, and there's a bunch of CVs and cover letters from industry professionals as well. Gonna ask Luke to add his as well, so you guys can basically get access to that and hopefully land yourself a job in Federated Hermes as well. So yeah, man, just be sure to sign up to that as well. I'll put the link just here so you guys can actually just go to it directly. Sorry guys, this is just a shameless promo before we wrap up. And then lastly, like, one thing I was also gonna say as well is that I'm gonna share a feedback form just after this call. I'll send everyone an email kind of thing. If you guys can just provide feedback on how you found the session, feedback on how we can make it better as well, because, you know, this is for you guys at the end of the day. But, you know, really love the interaction from you guys. And it's been great to just kind of like, you know, get this forum together where we can, like, you know, really delve into some insights from actual working professionals. And the one thing I would also say as well is that, you know, over the coming months, Beyond Education are going to be working with some great companies as well. So now is the time to really be a part of our community, because, you know, once we get these opportunities from these companies, we're very much going to be coming to our community to provide those opportunities to you guys. And yeah, man, with that being said, we'd like to wrap up, man, and everyone have a great evening.